Welcome back to Lamb's Cryptoverse, and good morning, good afternoon, or evening. Today I'm going to talk to you about the Fed fund rate news, which is a reaction to economic data, previous economic data, and then there's economic data that's from today, and then there's a market's reaction to all that data. So starting from the top, the Fed funds rate rose 75 basis points, which is as expected. This can be seen in the CME, let me look at my notes here, CME FedWatch, where everyone and their mother predicted a 75 basis point increase in the Fed funds rate. And as a result, the stocks rose and bonds actually behaved quite well. So the surprising news is that the 30-year rate actually rose, and maybe that's selling on the news. And there's some selling in shorter term rates. Otherwise, everything is as expected. If you recall, my framework is that stocks rise in the short term until the S&P reaches about 4150, so we're getting a short covering rally, and you're seeing that today. And after that, you're going to get a sharp decline in stocks. So why do I feel that way? Well, first of all, we've got very strong economic data. We're near a tipping point where economic data is going to weaken sharply, but we haven't gotten there yet. So far we've got 5 data points, economic data points that are very strong. We've got retail sales much higher than expected, the stronger PPI, CPI, and a very, very strong labor report. And today we had a very strong durable goods report that was up 1.9% in June, month to month. And if you exclude all the volatile stuff like aircraft/transportation, the durable goods number was really strong. The only weak number is the surveys, and there are 2 surveys from the University of Michigan and Conference Board, surveys of confidence. Those have been low, but hard economic data, and which is what the Fed looks at, has been very strong. But going forward, we're going to see a sharp weakening and economic data. But first it's going to start with the survey data. And the best place to look for that is ECRI or ECRI or the ISM PMI Purchasing Managers Index data. Sorry for all the acronyms, but that's what they're called. So going forward, you're going to see weakness in that data. And then investors are going to start worrying about declining earnings. So they were worried about that in the second quarter, but I think we're going to make it through the second quarter in one piece without getting hurt. Actually, stocks are rallying because there was so much fear that there's going to be weak earnings reports for the second quarter. Not only have earnings reports been okay, but guidance, which has been somewhat weak, has been better than the whispered numbers, as they call it. And we saw that with Microsoft, Spotify, and Alphabet/Google. So I just want to go over my framework. I was going to do a video just on my framework. I haven't gotten there yet, but I'm just going to go over the overall framework, what I think everything's going to do for the next 6 months. I designed this early in this year, January 2022, and it's about 6 months later, and everything's about the same as I expected. But what I'm expecting may shock you because I'm looking for things that are much worse than what everyone's expecting. S&P is down 16% year to date, and it's down less than 70% from its all-time high. I'm expecting to decline double that, at least 40%. I'm expecting the yield curve to invert, or what's already doing that, but I'm expecting a much more inverted yield curve than we have right now. I continue to expect the Fed funds rate to rise, but I think the next quarter, the next rate increase is going to be 50 basis points instead of 75 bips, and then maybe another 50, and then 25, and then that's it. I don't agree with the dot plot, and if you look at the Fed fund rates futures, they're not aligning with the dot plot. The futures are almost 60 to 75 basis points lower than the dot plot for 2023. So investors going forward, don't expect the Fed to keep raising rates as aggressively as they say they are going to. And precious metals, if you notice, everything's going to align with each other. And precious metals is another example. If stocks are going down because of tightness in liquidity and higher rates, you're going to see precious metals decline, and that's exactly what I'm expecting. I continue to expect declines in gold, silver, platinum, and palladium, and I expect gold to bottom around $1,500, which is not too far from where it is today. It's holding up actually better than I expected. I think gold is sniffing out lower interest rates for 2023, so that's why it's holding up. But still, the expectations are for lower gold prices. And lastly, since Bitcoin and cryptocurrency is correlated with the stock market, I'm expecting Bitcoin to be much lower. I'm bullish on Bitcoin and cryptocurrency long term, but I think we need to like see what's in front of us. Like we need to admit that Bitcoin and crypto is highly correlated with stocks, especially tech stocks. So if you think like me that tech stocks and the stock market are going to decline, then you have to expect lower Bitcoin prices. So everyone is expecting Bitcoin prices to have bottomed already at around $17,500, something like that. Around low under 18,000 a few weeks ago was a bottom. What people think of the bottom in Bitcoin prices. I think they could go much lower because the stocks are going to force them down. What I'm looking at is I'm attaching a beta of around 1.3 or 1.4 to Bitcoin versus the NASDAQ. So if the NASDAQ continues to decline, which I think it will, crypto will decline with it. So that's my market wrap up. Again, just to close everything, we've got strong economic data, which the Fed expects to continue raising rates because of it. And stocks are rallying because they're short covering. And this is very typical in a bear market, these very strong short covering rallies. So just don't get fooled. I think the S&P is going to hit its 200-day moving average and then hit resistance at that point. I think that's going to be around 4150 on S&P, and that's only a few percent from where we are now. So be cautious. So enjoy the ride, but sit in the exit seat of the plane with your parachute because I think we're going down. So again, thank you for listening and joining us again at Lamb's Cryptoverse.